There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB this Wednesday. I'm Juliette Sarli. Lovely to have your company on not such a lovely day for the market. Let's have a look at where we are tracking. And yes, it just looks like taking the stairs down, doesn't it? The worst drop I think we've had since April, Liberation Day, down almost 2% in today's action. And of course, all 11 sectors in the red today, very much dragged lower by tech stocks, which is what we saw was behind the weakness on Wall Street overnight. So as everybody always says, that great song goes, wake me up when September ends. And that really takes us to this September slump that has started the new month after a very solid August during reporting season where we gained more than 3%. Now we had the GDP figures out today. They were better than expected, and a consumption catalyst here. It was us, the consumers, opening our wallets thanks to interest rate cuts, likelihood of more interest rate cuts, and end of financial year sales really driving us to open our wallets whilst we saw government spending kind of peter off in the quarter. But does that stronger rather than expected GDP print mean that September's cut is cancelled? Well, many do now think so. I was speaking to Stephen Walters from Optimal Economics straight after the announcement, and he was saying, yeah, it's more likely now that you'd push it out to November. And of course, there's still one penciled in for the first quarter of 2026 as well. Let's get to the sell-off though on the market, and it really was these tech players dragging us lower, with the exception of NextDC, which seems to be everybody's favourite pick after reporting season. WiseTech down almost 4%, Xero there down by around 6%. Tech One and Zip also under pressure. Looking at the banking stocks today, they were heavily sold off as well. CommBank down by 3.5% to below $165 a share. We also had a broker call on Westpac. But of course, the gold players were where you could find a little bit of support today. Northern Star up 0.4%, Bellevue and Greatland also looking good. In terms of company news, COG Financial Services up almost 10%. It bought salary packaging business and novated leasing business Easy Fleet for $40 million. WiseTech we mentioned lower, and Citi did retain its buy rating on the stock, but also slashed its short-term price target by 9% to $121.35, citing near-term growth concerns. Medibank shares also under pressure, and that's despite news that former SA Premier Jay Weatherill, who's now a director on the board, bought another 30k worth of shares. And GrainCorp jumped almost 4%, and this is after RBC Capital Markets lifted its short-term share price for the country's biggest agribusiness to $10.50. They're expecting a bumper winter crop. Westpac, as we mentioned, under pressure, and this was also due to UBS changing its rating on the big four banks to neutral from buy. Let's get to our guest, and welcome to the COB, Mark Gardner from MPC Markets. Mark, great to have you with us.
Good afternoon.
Let's start with GDP. So that pretty much pushes out the September cut likelihood.
Yeah, look, it probably does. I mean, in the scheme of things, I don't really subscribe to having to pick the exact day. I think there's another 2 cuts coming, and when they happen, I think is really up to, because I think we're going to get some economic weakness. I think the US is starting to slow down. Tariffs have taken a while to kick in. We're starting to see some green shoots in China. There was a good PMI number over the weekend, but that seems to be given back almost immediately today. Asian indexes are actually very weak across the board today. It's not just Australia. So that usually spells out to me that's global funds just selling index broadly. So we probably that may lead into the US tonight. The US was down about 1.5% on the Europe Open last night, so it did recover a little bit. But But yeah, I think we'll start to see things slow down a little bit. And look, the retailers did so well over earnings season. It probably, in hindsight, Blind Freddie could have told you that consumption was up, I suppose,
Yes.
because they all did very well, and quite surprisingly so. So, considering everyone was screaming for rate cuts, but yeah, I think there's no major urgency, and the central banks are still just trying to get as much data as they can. Obviously because there's inflationary pressures from tariffs, and then slowing jobs market in the US. So I think Friday's still a very pivotal point for the market, and that number will likely decide the whether we have a horrible September or whether it's just a seasonally sort of a breather.
Weaker one, yeah, and that tends to be the case. So how do we embrace this seasonal weakness, or I guess not fear it?
Well, you just got to be well planned, essentially. We went to cash back in March, and I was concerned about April, the Liberation Day. Certainly did not expect it to drop 21%, don't get me wrong, but we do an exercise with our clients whereby earnings is out of the way now, September's seasonal weakness, take things off that we're, things that you're not really that sure about, where if your sentence starts with, I hope this goes up, if the word hope comes into it, you probably should be trimming or selling it. And sit in some cash for a period of time, because the value of that cash, if we do get some form of dip, even if it's 5 or 10%, you can really start to load up basically into that weakness, because what we found, we did a lot of statistical studies on indexes and stock markets since 2009, since we went to zero interest rates. And the bounce out's only about 120 days these days. Pre-2009 it took 560 odd days for it to get back to break even. These days it's 4 months, or just under 4 months really in terms of trading days. So you want to be really well organised. Go to a bit of cash, get rid of those things that aren't working. Earnings season, particularly in Australia, you're 6 months away from there being another genuine catalyst for turnaround stories. So don't just hold on to those stocks that with your fingers and toes crossed. And then just write yourself a shopping list, basically. It's strangely enough, it's the only place in the world where everyone gets super upset when the market goes on sale. But if you buy well in those periods, you can actually do really, really well. Yeah. So it's more being blindsided by it that's the problem. But if you prepare for it, you can usually make quite good money.
Well, where you are making good money is in gold and silver. You guys at MPC have been long this trade for a while. Is it continuing?
Yeah, I think it is overall. I think probably the strength in the gold will be gold miners. We got record highs, and so the all-in sustaining cost in the GDX ETF, for instance, is around about $1,307 US. So those margins, as gold goes up, if it goes to 4,000, say, you'll make more money extrapolating out the EPS on the gold miners than you will being long gold itself. So with that comes mine risk, etc. So that's where an ETF's quite good. And look, silver as well, it's pretty hard, but we've had Polymetals has done fairly well. It's a new listing, a small listing. But silver breaking through, it got up just shy of $42 the other day. But the 50-year average in the gold-silver ratio would see silver at somewhere in the high 50s, and that would just be returning back to the the 50-year historical average, really. And there's more industrial use now for silver in solar, electronics. So look, I think that is a bit of and platinum as well, quite forgotten. I mean, remember I started in markets in the 90s. Platinum was around $1,200. It's only $1,400 now. Gold was $200-300. So there can be some significant catch up, and 90% of the world's platinum comes out of South Africa and Russia, which is the R and the S in BRICS. So any geopolitical issues there, and Mexico as well is the biggest producer of silver. So three countries that Trump's really picked on quite hard over the course of the last 4 or 5 months. So I think there's significant upside there. I mean, silver can, when it goes on bull runs, it can quite often double, but I'm just going to stay with the sensible view and say, look, I still think there's 50% upside here over the next 6 months. and and it does tend to go in a pretty straight line when it goes. So it's a shame we don't have we've got so many miners in Australia, and there's not many silver miners.
Yeah.
So
we're going to keep digging and find some silver. All right. Thank you, Mark. Mark Gardner there from MPC Markets. All right, getting back to stock specifics, and the stock of the day was COG Financial, and Andrew spoke to our experts, Jonathan Takadina, also from MPC Markets, and Nathan Somasundaram from Deep Data Analytics.
They're in a good space, meaning that they're taking advantage of asset financing within that space. It's another one of those companies that's financial plumbing. They're lending out money. They're in the sweet spot there. So this actual acquisition, good thing is that it was actually done at 6 times. They're trading at an 18.5 PE, so there's that instant uplift, and that's what the market's priced in today. So for me, look, it looks like these operators are in a sweet spot. They know how to acquire these companies at reasonable values. If they keep doing that, it should increase in share price. So for me, that's a buy.
Everyone is trading at historical high, just like the asset prices. Now, this is where you have to realize that these are cyclical. And when the cycle turns, you will face the downside risk. It is trading at the highest level since the GFC. So they've done a lot of things right, and it's working because you're on the right side of the cycle. But even the biggest gorilla, when the cycle turns, will struggle. So you've got to keep that in mind. Right now, I think they're doing the right things. Things are working. RBA is cutting rates for stupid reasons to pump property. And so because of that, you've got the thematic working for you. So I think they're doing okay. I'm not putting fresh money in there. It's a hold for...
All right, the worst day on the market since April. Did we have any leaders? Let's have a little search. GrainCorp, of course, on that broker upgrade, up almost 4%. Tabcorp also on a broker upgrade, I think hitting its highest in 2 years. Bellevue Gold, of course, lifted by the overall momentum in gold stocks. To the downside, though, today there were plenty of those, particularly in the tech space. Xero down 6%, WiseTech Global down almost 4%, also on a broker call. Let's have a look at the small end of town. 4D Medical had some news out today, and that sent shares up by about 56%. Race Oncology also looking good, up 13%. To the downside, in the small end of town, these stocks on your screen, including Prospect Resources, down around 14%. Tonight, we are looking out for the US Federal Reserve Beige Book, also the JOLTS job openings for July, which could dip to around 7.3 million. Factory orders for July, which could drop by about 1.4%, and earnings as well, continuing with Salesforce, HP, Dollar Tree, Macy's, and American Eagle. Tomorrow locally, we have the goods trade balance for July with a $5.5 billion surplus expected. The household spending indicator for July could jump by 0.7%. And some of the big guns go big ex-dividend, including BHP. Also, we've got Yancoal, Amcor, Bapcor, and NIB. So as I mentioned, one of the worst days on the market since the Liberation Day sell-off in April. We're down by 1.9% on the close. All sectors in the red here. We mentioned tech being a heavy hitter, down by 3.6%. The banks being hit. There was that broker downgrade going to neutral on the banks, down by 2.8%. And, the best performing stock was consumer discretionary, down 0.4%. Mark mentioned, of course, it probably wasn't a surprise that consumer or consumption really drove that GDP price figure. And to that, I would like to say you're welcome, Peters of Kensington in Barangaroo, because I think our entire office just cleared you out of your end of lease sale. All right, that does it for the COB for today. We'll be back from 9:45 a.m. Eastern. We'll see you then.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.